All right, let's get right into it. For years, the world of finance has leaned on these really powerful, elegant formulas to try and make sense of the absolute chaos of the stock market. But what if one of the most important models, one that actually won a Nobel Prize, has a huge blind spot? A blind spot that could make all the difference when things get messy.
I mean, that's the million-dollar question, right? Or maybe the trillion-dollar question. We build these incredibly complex mathematical models, all in an attempt to find some kind of order in what looks like pure randomness. But how close are they to reality? Today, we're going to look at a really cool attempt to fix a major flaw in how we've been doing things.
So to really get the flaw, we first have to get to know the reigning champion of financial modeling. It's a concept called geometric Brownian motion, or just GBM for short. For decades, this has been the absolute go-to for describing how asset prices move.
Now that name sounds super technical, I know, but the idea behind it is actually pretty straightforward. Basically, geometric Brownian motion assumes that a stock's price changes from day to day are random, but over time, they generally follow a trend, either up or down. This beautiful idea is the engine running the famous Black-Scholes model. That's the Nobel Prize-winning formula for pricing options.
And this model isn't just for finance, not by a long shot. It's incredibly universal. To understand why its weakness is such a big deal, you have to appreciate its power. Scientists have used the very same math to model everything from how wealth is distributed in an economy to, get this, the size of rocks after you crush them. It's a truly foundational idea.
Okay, but here's the twist. This is where our beautiful, elegant model starts to crack. When you hold it up against real-world market data, you see a problem, a big one. It's known as the fat tail problem.
And hey, you don't have to take my word for it. We can go straight to the source. The researchers who wrote the paper put it bluntly. The standard model, GBM, just can't reproduce the fat tail behavior we see in the real world. So what on earth does that actually mean?
Think of it this way. In the clean, perfect world of the GBM model, huge market crashes and crazy sudden spikes are supposed to be incredibly rare. They're outliers that live way out in the skinny tails of a bell curve. But we all know the real world is a lot messier. In reality, those tails are much fatter. Extreme events, both crashes and rallies, happen way more often than the classic model thinks they should.
Now, if you want to get technical for a second, the term for this is excess kurtosis. You can think of it as a kind of statistical fingerprint for these fat tails. The standard model, GBM, assumes this number is 0. It expects a perfectly behaved, normal world. But when you actually measure the market, you almost always find positive excess kurtosis. It's the mathematical proof that reality is just wilder than the model.
So here's the bottom line. The standard model, for all its brilliance, was essentially blind to black swans. You know, those super rare, high-impact events that completely rewrite the rules. It was systematically underestimating the true risk of chaos.
So, how do you fix a model that's blind to chaos? Well, this is where it gets really interesting. The researchers behind this new idea found their inspiration in a totally different field, the physics of how tiny little particles move around.
Let's talk about something called subdiffusion. In physics, this describes a situation where a particle, let's say a molecule inside a crowded cell, doesn't just wander around freely. Instead, it moves for a bit, then it gets stuck, then it breaks free, and it moves again. Its journey gets slowed down because of these little temporary traps.
And here it is. This is the big aha moment. The researchers realized this trapped particle idea is a fantastic analogy for financial markets. Think about it. A stock price isn't always moving in a smooth, constant flow. During quiet times, when there's low trading activity, the price can get trapped. It just flatlines for a bit. Then, a burst of trading happens, it breaks free, and starts moving randomly all over again.
So by building that physical insight right into the mathematics, they created a new, much more robust model. So let's meet the new challenger, generalized geometric Brownian motion, or GGBM.
The big innovation here is actually simple, but it's also profound. See, the old model just assumes prices are always on the move. But GGBM accepts that, you know what, markets pause. By actually including these trapping events in the formula, it does a much better job of capturing that jerky stop-start rhythm of real trading.
This table lays it all out perfectly, so let's just walk through it. First up, realism. The standard model imagines this smooth, continuous ride.
The new model, GGBM, is way better at capturing the reality of market pauses and lulls in activity. Now, for extreme events, and this is the big one, the standard model dangerously underestimates the risk of crashes and spikes. GGBM, on the other hand, more accurately reflects that true fat tail risk we talked about. This makes it way better for markets that aren't always super high volume.
Okay, so a new theory is great and all, but the real question is, does it actually work? Does it give us better answers when you apply it to actual, real-life market data? Let's find out.
To figure that out, the researchers took their new GGBM model and put it to the ultimate test, pricing real stock options for two of the biggest, most watched companies on the planet, Tesla and Apple. So this isn't some abstract exercise. This is a head-to-head battle on the classic model's home turf.
And the results? They were really compelling. The new GGBM models were just a better fit for the actual prices you see in the market. For a volatile stock like Tesla, the new model did a significantly better job. And what's really cool is that it helped explain a famous puzzle in finance called the volatility smile. That's basically a weird pattern where certain options cost more than they should according to the standard model. The classic model has always struggled with this, but GGBM helps clear it up. So what should we take away from all this? First, our standard models are brilliant, no doubt, but they are not perfect. Second, amazing new ideas can come from the most unexpected places, like in this case, physics. Third, this new GGBM model just gives us a more realistic picture of the market by admitting that prices stop and start. And finally, and I love this, it's just a great reminder that science is always a work in progress. Even Nobel Prize-winning ideas can and should be improved on.
It really gets you thinking, doesn't it? If an idea about tiny trapped particles can help us understand multi-billion-dollar stock markets better, what other fundamental secrets are out there, just hiding in a totally different field of science, waiting to be found?